An anomaly is recorded in the archives of Vermont's financial history that breaks the back of traditional economic theory. The subject of observation, Ronald Read. Social status, low-level service personnel. Location, J.C. Penney store. His main tool was a mop. For decades, this man existed in society's blind spot, performing a function that the majority defines as the social bottom. He cleaned up the dirt after those who considered themselves the masters of life. His existence was devoid of gloss, air-conditioned offices, and business cards with loud titles. To an outside observer, this was a scenario of absolute defeat. His education was limited to high school, a career was non-existent as a class, and his biography seemed like a gray ribbon of hopeless routine. However, beneath the janitor's uniform hid one of the most effective capital operators of his generation. While society, blinded by the external attributes of success, ignored his presence, Ronald Read was building a financial fortress in complete silence. Born in 1921, he internalized the lessons of the Great Depression at a neural level. The crisis of 1929 became for him not a trauma, but a vaccination against wastefulness. While his colleagues spent their lunch breaks on empty talk and complaints about fate, burning resources they didn't have, Read disappeared into the public library. This was not escapism, it was reconnaissance. He didn't read fiction. He devoured financial summaries, corporate balance sheets, and stock market reports. A man who never crossed the threshold of a university independently uploaded algorithms into his brain that would make any Harvard MBA graduate blush. His strategy was based on two fundamental constants, of which 99% of the population is in deficit: patience and prudence. No day trading, no speculation with trendy cryptocurrency, no insider tips from dubious relatives. Read focused his optics on boring, predictable giants. He bought shares in companies whose products people use daily, regardless of the political regime or the phase of the moon. Colgate-Palmolive, American Express, Johnson & Johnson. These were corporations that didn't promise instant enrichment, but guaranteed dominance over a horizon of decades. His portfolio was diversified by sector, creating an indestructible structure working in the background, while the architect himself continued to wash floors. The most disturbing aspect for an outside observer was the complete camouflage of capital. While accumulating millions, Ronald Read lived as if his bank account were empty. He drove a used Toyota Yaris, although his liquidity allowed him to purchase a fleet of German luxury cars. Neighbors and acquaintances perceived his asceticism as eccentricity or a noble detachment from the material, noting his refusal to play the social game of superiority. It was this mimicry, this refusal of performative wealth, that allowed him to remain a financial ghost. No one suspected the scale of what was happening, because the subject sent no signals associated with money. The moment of truth arrived in 2014. Ronald Read's death at the age of 92 ripped the covers off reality. When lawyers opened the will and conducted an inventory of assets, shock paralyzed his loved ones and acquaintances. The humble janitor, who never had a real career, left behind a fortune exceeding $8 million. This sum was accumulated exclusively through stocks, bonds, and real estate, without the involvement of lotteries or inheritances. Here, a cognitive dissonance arises that destroys the self-esteem of the modern professional. A person with higher education, a prestigious position, and a diploma on the wall is most often in a state of technical bankruptcy or drowning in credit obligations. Meanwhile, a janitor without education generates $8 million in net worth. The problem of the educated class lies not in the lack of income, but in a fundamental misunderstanding of the mathematics of poverty. Emile Connoton 26, 15.17. Ronald Read cracked the code that remains inaccessible to the majority. Wealth does not correlate with the size of the salary. It correlates with the capital retention rate. Until this algorithm is rewritten in the consciousness, no raise, no bonus, and no accidental luck will save the system from collapse. There is a fundamental delusion that keeps millions of educated professionals in a state of permanent financial suffocation. It is the belief that high income automatically converts into wealth. Reality dictates the opposite. Without sealing the expenditure contour, increasing the flow of resources only accelerates the destruction of the system. The modern holder of a diploma hanging on the wall is often in a worse position than an unskilled worker because his debts scale proportionally to his status. The problem is not a lack of funds. The problem is a complete misunderstanding of the mathematics of poverty, which works mercilessly regardless of the size of monthly inflows. The main agent of this destruction is named lifestyle inflation. It is a silent killer of capital, acting unnoticed by the victim. The mechanism triggers instantly at the moment of an income increase. As soon as the figure on the payroll grows, the subject immediately activates the consumption protocol. The car is updated. The apartment is changed to a more prestigious one. The wardrobe moves into the luxury category, and the frequency of restaurant visits increases. The person convinces himself that he deserves it, but the mathematical result is always the same. The new, higher profit disappears at the same speed as the old one, leaving a zero balance. The subject runs faster, but the horizon remains at the same distance. He earns more, but keeps nothing. Instead of expanding the margin of safety, there is an expansion of the zone of vulnerability. Instead of allowing income to grow while expenses remain at the same level, creating space for maneuver, the person voluntarily tightens the vice around his own neck. The neighbor in the expensive car and branded clothes is perceived as a winner. But in most cases, this is merely a theatrical production. This is a performance of success, the price of which is a burned future. The neighbor is not winning. He is playing a role while his balance sheet bleeds out. The situation moves into the terminal stage when debt is introduced into the equation. The attempt to build capital while having credit card debt at 18% per annum is an act of mathematical suicide. Getting ahead at such a rate is technically impossible. This is a situation where someone else extracts wealth from the subject at a speed that works against him, intensifying every month thanks to compound interest. The financial industry turns carriers of high intellect into cash cows, exploiting their desire to match imposed standards. The pursuit of external attributes, the desire to show the world one's rise, blocks the very possibility of achieving that rise. Every dollar spent on creating the appearance of success is a dollar removed from the army of assets, which will never be able to work for the master and will never buy him freedom. Most people with high incomes are already financially dead. Their hearts are still beating. They go to work and sign contracts, but economically they are corpses, moving solely by the inertia of debt obligations, waiting for the inevitable collision with reality when the music finally stops. Consumption is no longer a function of economic necessity. In the modern world, it is a neurochemical glitch, an attack on the limbic system. The desire to demonstrate progress here and now is not a sign of dominance, but a symptom of structural weakness. Most subjects never reach the point of critical mass of capital for one banal reason. They are biologically incapable of enduring voluntary discomfort. They require an immediate injection of comfort, a tactile confirmation of status in real time. Emile, Somonaldo News 2026, 15, Gnadevson. As a result, the system acquires objects that generate an illusion of success, but guaranteed leave the balance ruined forever. This is a war of two types of pain, and the choice is inevitable for every organism. The pain of discipline weighs grams, the pain of regret weighs tons. The human psyche, devoid of the delayed gratification gene, is doomed to an endless chase for quick victories. An operator incapable of waiting will work all his life trying to overcome this defect, but without rigid, almost surgical behavior correction, will end the cycle with a zero result. The market, like nature, does not forgive impatience. The desire to get compound interest without waiting and skill without practice keeps the subject in one point of space year after year. The emotional background exacerbates the defeat. Envy, resentment, and self-pity become toxic fuel for making erroneous decisions. Self-pity borders on clinical paranoia, and this state is one of the most difficult to reverse. The subject observes external attributes of someone else's success, a premium class car, demonstrative vacations, and generates a sense of injustice. An optical illusion distorts reality. Half of the objects of envy are technically in a state of insolvency, financing the facade of a beautiful life with money that doesn't exist to impress an audience that is indifferent to their existence. True wealth is invisible by nature. It is the art of possessing a resource without becoming a subject of discussion. It is the rejection of brand markers and rented luxury in favor of quiet, monotonous asset accumulation. When no one expects a person to have capital, the pressure to spend for the sake of proving one's significance disappears. The loudest declarations of success usually come from bankrupts. Those who own seven-figure portfolios pass by in cheap trousers, remaining unidentified. However, the modern environment is designed as a perfect trap. We exist in an ecosystem of instant access, where one touch of a screen causes months of savings to evaporate in exchange for a dopamine spike from the delivery of useless cargo. Relying on willpower in this battle is a strategy leading to guaranteed defeat. Dopamine cannot be defeated by a frontal attack. Human biology is programmed to destroy one's own future for the sake of a second of pleasure in the present. And this enemy is not in the market, but inside one's own skull. Complexity is a marketing product, not a tool for capital generation. There is a rule capable of saving the system from fatal errors. At the moment when someone tries to sell the subject something complex, the protocol must issue an automatic refusal. Expensive life insurance, convoluted investment schemes, any assets requiring a salesperson to convince of their necessity. All these are mechanisms for extracting resources, not accumulating them. Ronald Read's portfolio consisted of entities so boring they induced yawning. Colgate-Palmolive, American Express, Johnson & Johnson. These were predictable corporations that do not create millionaires overnight, but inevitably form dynastic capital over a distance of decades. The decisive variable in this equation is not intelligence, but the capacity for inaction. In the context of building wealth, temperament weighs more than IQ level. Big money is never made in buying or selling. It is made exclusively in waiting mode. Most market participants are physically incapable of withstanding this stasis. They confuse hyperactivity with productivity, constantly moving capital, chasing trends, and reacting to volatility. Every extra movement activates penalties. Commissions are paid, taxes are levied, and the work of the most powerful force in the universe, compound interest, is interrupted. The anatomy of success. Berkshire Hathaway confirms this thesis. If you surgically remove the 15 best decisions from their history, the remaining track record collapses to the level of mediocrity. Эмиль, 19 февраля 2026 года, 15:17. The result was achieved not through fuss, but through extreme patience, alternating with instant decisiveness when opportunities appeared. The majority does exactly the opposite. People cannot stand being boring on purpose. They require a feeling of victory here and now, which forces them to buy assets that give a sense of success, but lead to eternal bankruptcy. The first law of compound interest is absolute. Never interrupt the process without critical necessity. Understanding this force is the key, but most never give it enough time to accelerate. When capital is withdrawn from the investment circuit to purchase a consumer good, the loss is not limited to the nominal amount. The system destroys all future exponential growth that this money could have generated. It is the murder of compound interest in the embryo before it had time to become significant. The illusion that wealth requires sacred knowledge or insider information is false. It requires the avoidance of stupidity. It requires refusing attempts to outplay the market and accepting the tactic of boring accumulation. Every interruption of the cycle resets the timer. The growth curve breaks. One emotional decision, one moment of weakness when the desire to possess a new thing outweighs the mathematical logic of retention, equates to financial suicide, the consequences of which become irreversible. Relying on willpower in financial matters is a strategic error leading to system collapse. In a world of hyper-accessibility, where one touch of a screen initiates a withdrawal of funds, the human brain is incapable of constantly resisting impulses. Dopamine always defeats discipline over a long distance. Attempting to win this battle with frontal effort is useless. The only way to preserve capital is to exclude the human factor from the equation, handing control to a dispassionate algorithm. The defense architecture is built on the principle of complete resource isolation. It is necessary to create an external circuit, an account in a third-party bank that has neither a linked plastic card nor a mobile app on the owner's phone. This is a digital safe, invisible in everyday life. An automatic protocol is set up. Every time income arrives, a fixed sum is instantly transferred to this vault. These funds receive the status of forbidden. They disappear from the field of view and consequently disappear from consciousness. This is exactly how people with minimal incomes accidentally accumulate hundreds of thousands. They do not rely on self-control. They remove the option of spending physically. Discipline is an unreliable asset, dependent on stress levels and fatigue. Automation is absolute. It is indifferent to how the subject feels. It executes the accumulation protocol day after day, month after month, year after year, while the owner sleeps, works, or loses motivation. While the rest wait for inspiration to save, the system builds wealth in the background, regardless of the operator's desire. However, The automation of financial flows requires a parallel automation of intellectual renewal. The difference between those who build capital and those who merely imitate activity lies in ruthless, endless learning. In the biography of any wealthy person, constant reading is present. This is not entertainment, but data uploading to expand the understanding of reality. Successful subjects are often not the smartest by nature, but they function as learning machines, going to sleep slightly more competent than they woke up. There is a rigid rule: sell 1 hour a day to yourself. Before giving time to an employer or society, the subject is obliged to invest 60 minutes in increasing their own market value. The majority refuses this deal, citing fatigue or lack of time, preferring stagnation. But the acquisition of wisdom is not a bonus. It is a moral debt to oneself. To remain ignorant when knowledge is available is a conscious choice. It is this choice, and not external circumstances, that guarantees the preservation of poverty. Эмиль, 19 февраля 2026 года, 15:17. A stop in learning means not just a pause, but the beginning of capital necrosis. Time is the only asset in the equation that is not subject to recovery. It is a variable with a negative coefficient. With every turn of the calendar, the cost of entry into the wealth system grows exponentially. The difference between starting capital accumulation at 35 and at 45 is not just 10 years of calendar time. It is a fundamental gap between a scenario of a calm end to life and the necessity to work until the moment of the organism's physical failure. Every year of delay is a year of compound growth that was killed in the embryo and will never be compensated. It is another year of paying interest on other people's capital instead of receiving interest on one's own. There is the inevitability of pain. Life is guaranteed to deliver discomfort. The question is only in the choice of its form. The subject stands before a binary choice: the pain of discipline or the pain of regret. The first weighs grams, the second weighs tons. The majority chooses regret because discipline requires sacrifice in the present, whereas regret comes with a delay. This is an error in time perception. The pain of discipline is temporary. Adaptation occurs. It becomes the norm. The pain of regret, on the contrary, accumulates. At the age of 65, when looking back at decades of burned resources and missed opportunities, the weight of this burden becomes unbearable and crushes the personality. History knows examples of this asymmetry. Mozart, possessing the status of the world's most famous composer, lived a life in financial agony because his expenses always exceeded his income. Genius does not save one from the math of poverty. If a subject with talent on the level of Mozart is incapable of outsmarting the system, the average layman shouldn't even try. In contrast to him, there is the example of a federal judge who, without having super incomes, spent less than he earned all his life, fearing for his wife's future in an era without pensions. One chose impulse, the other discipline. One family ended in ruins, the other in safety. The money was similar, and the outcome was determined by behavior. Wealth is not created by one heroic effort. It is not an event, but a process. It is formed by a series of microscopic, boring decisions made consistently over decades. Save 50 currency units, track expenses, avoid debt, do not interrupt compound interest, ignore lifestyle inflation, automate transfers. None of these actions in isolation changes the picture in a month, but their aggregate, compressed by time into 10 or 20 years, transforms reality, turning dependence into absolute freedom. Successful system operators are not smarter or luckier than the rest. They simply avoided stupidity longer. They were not distracted by market noise, did not give up during periods of stagnation, and continued to perform routine actions until they yielded an extraordinary result. A salary with 6 zeros is not required. A strategy with 6 zeros is required. This strategy begins with a tough decision. The future is more important than current comfort. You need to become rich only once. There is no need to storm this peak 4 times, but this single time requires a complete refusal of self-sabotage. The choice is final. You can continue to imitate activity and hope for a miracle that will not happen, or accept the fact nothing will change until behavior changes. The salary is not the problem. The problem is the operating system in the subject's head. The dividing line runs between those who did the work without desire, who saved when they wanted to spend, and who learned when they wanted to rest. 20 years later, some receive freedom. Others remain in a cage. A third option does not exist.